really delighted to be hosting this conversation and super excited about the panelists that I have who I'm going to let introduce themselves very shortly. But the topic for today is really covering the investment landscape, looking at how markets performed throughout 2025, which was a little bit of a wild ride that we all were on, looking at some of the sort of geopolitical things that have been going on around the world and thinking about some of the opportunities that are ahead of us as we head into 2026. For those of you who don't know me, my name is Frankie, and I have my own wealth management company called FSWM, where I work with families and entrepreneurs on their financial planning. And I also have a community of which many of you are part of, called Frankie's, which hosts events like this. And I will now pass over, if we start with Rebecca, to introduce yourself.
Yep. So I'm Rebecca Jones. I'm a senior investment director at Rathbones. I joined what was Investec Wealth and Investment 10 years ago, so it's my 10th year there. Already bumped into one of my former colleagues next door, which is lovely. But we merged with Rathbones in 2022, so that's the name that we now go under.
So hi everybody, my name is Claire Lincoln and I lead the institutional relationships team globally at the World Gold Council. So we are a not-for-profit organisation and we raise awareness about gold, its attributes and the role it can play in a portfolio without actually selling it to investors. So we're a company of about 70 people and we live, breathe and sleep gold. So looking forward to sharing some insights.
Thank you.
Hello, I'm Edward Johnston. I'm head of the investment management team at the private bank Arbuthnot Latham.
Perfect. Thank you so much. So how I normally structure this for those who haven't been to one of these events before is we have about half an hour, 40 minutes of panel discussion, and I put some questions together for the panelists, and then we open to the floor to questions. So if you do have questions along the way, please hold on to them because we want this to be as interactive as possible. So first of all, I'm going to kickstart with you, Rebecca. Obviously, as I touched on, 2025 was a relatively wild ride in the stock market. Can you kind of take us back to what went on throughout the 12 months and the kind of impact that it had across the year?
Yeah, so I think it's fair to say that most people, ourselves included, were definitely surprised by just how strong 2025 was in global financial markets. It did feel very much like a game of two halves. The first half of the year was very much dominated by Trump's tariffs. People were, trying to digest the full impact of those. There was a lot of volatility around that. And then in the second half of the year, markets didn't just stabilise on the back of the various trade deals that we saw, but they were sort of propelled ever higher. We saw more rate cuts come through, corporate earnings reports surprised on the upside. So all of those things kind of helped markets deliver double-digit returns over the course of the year. I think what was really interesting was, it wasn't just US-led last year, which is what we've seen for the couple of years prior. Even emerging markets managed to outperform the US, and that hasn't happened for quite some years as well.
Brilliant. And that momentum that you were talking about has largely continued into 2026 as well. Ed, what areas of the market are most exciting you at the moment?
Yeah, perfect. So I think you can get excited with a lot of stuff. So I don't think almost anything that you think even is doom and gloom or areas that you're worried about. There's always a bull market somewhere in the world. It's for us to try and find one. Probably to keep it sort of broad based, carrying on. I'd probably say emerging markets this year. I think you've got a lot of tailwinds there from valuations. They're not cheap. Nothing's really cheap right now, but they're certainly cheaper than America. You've got big tailwinds, as in help from things like the dollar. So last year, really, equities was the main driver, but also the dollar was probably one of the most powerful forces, and that links in with gold as well. And so if you think that the trend continues, and there are phrases that the trend is your friend, and you think the dollar will continue to weaken, emerging markets is probably quite a nice place to sit, and you can do it via equity markets, and you also can do it via the bond market as well.
Perfect. And just to follow on with you, Rebecca, is there other areas or that you in a similar place as Ed that you're excited about?
Yeah, I think to concur with Ed, I think that rest of the world trade has probably still got a little bit further to go. I think one area that the market's potentially underestimating the sort of fiscal spending that might start coming through is Europe. So valuations are still not demanding, particularly relative to some of their US counterparts as well. But I mean, you've got things like Germany's infrastructure bill. They're about to spend 500 billion euros. That's 12% of their GDP over the next few years. That's absolutely enormous. So I think there's there's a bit more room for an upside surprise in some of those kind of ex-US regions. Yeah.
Perfect. And Claire, obviously gold has been having its moment for the last couple of years. Can you kind of talk us through a little bit about what's been driving that? Yeah, actually, I'll save my next question.
Yeah,
What's driving
it's
it?
definitely been a great time to be sitting in this seat, because there's nothing better than an asset performing that, I guess, beyond your expectations. But I think the first thing I would say is an asset like gold performing 6-7% in any given year is not normal. It wasn't anything that we were forecasting, expecting. So you do have to take that with a pinch of salt. It had a phenomenal 2025. There were various catalysts that drove the performance. I think that's the key thing. Sometimes with gold, I think investors are thinking that it's only driven by rates going down or the dollar going up, but it's actually driven by multiple things, given that it's both a consumer good and an investment good. So gold is jewellery, gold is used in technology, gold is also an investment that you can put in your pension, in your ISA, and it's also something that central banks buy as part of their reserves. So you've often got to break down the drivers and also think about, what is it bringing to you as an individual? Why are you putting it in the portfolio? But the catalyst really for gold going back to 2022 was the Russia-Ukraine war. And it was really brought into question sanctions, and it brought into question, what do I have in my portfolio as a central bank that can protect or do well in these types of scenarios? So central banks traditionally buy gold because it protects against inflation, but it also critically in times of crisis. And that's really where we've been, I think, for 4 or 5 years. So we've seen a real surge in central bank buying from 2022. We saw 3 consecutive years of them buying more than 1,000 tons. That's a lot. And this year, once we get our full year figures, we expect it to be slightly under, but it will still be well above the 5-year average. So it's almost been a story of participation by many. Central banks probably started it, but if you look at just last year alone, there was broad-based buying from ultra high net worth investors, retail investors, institutional investors like pension funds, because I think so much has shifted now in the background. It's something Ed and I were talking about earlier, that the landscape now is really different. You've got things behaving in a way that they haven't behaved before. And something that I was just reading before I left was, a pension fund saying that they're coming out of US Treasuries now because they don't really understand any longer what constitutes a safe haven. And I think that's going to be great for something like gold, because it does protect you against various shocks.
Yeah.
But the fact that we're probably going to see a big shift of investors coming out, not completely saying, I'm no longer investing in anything that's denominated in dollars, but we'll see change at the margins. And then I think gold, all precious metals as a group, have got a lot of upside to capture there.
Yeah, and we were speaking at the weekend about, and I think you were saying about something you'd read about the word of the of 2026 is instability.
Yeah.
And being comfortable with that, because things aren't necessarily behaving and haven't been for many years as you would expect.
Yes.
So where you've seen returns may not be where the returns are going to come. And I think that's why it's really important to be aware of your positioning as you go into the year.
Yeah.
Ed, there's been a lot of noise around kind of AI bubble, and obviously a lot of this market has been driven by US technology stocks. Can you talk to us a little bit about your views on that and how you're positioning portfolios with that in mind?
Yeah, so it brings me to mind a bit. So you talk about instability. First thing that pops into my head is my team don't know this. So I told them back end of last year, I was like, you need to be comfortably uncomfortable. They said, oh, that's great. It actually came from my Peloton coach. but that's sort of where you talk about instability. That's where in AI you need to be sort of comfortably uncomfortable in our view. So we are pro AI, we are long tech, but everything is in moderation. When you say that, well, it's are you here? Are you here? Are you very long? So for me, earnings growth is really rapid. So the profitability of these companies is significant. Is this like, the common question is this like the dot-com bubble? Is this how is this going to be similar? And the earnings story is different. They're making real profits, where in 2000 you weren't. There is a whole consumer angle where in 2000 the dot-com, it was deflationary prices. Effectively, you were cutting prices to try and get customers, effectively market share. Pretty much everyone in the room, whoever pays ChatGPT, if ChatGPT puts it up by $1 tomorrow, are you going to pay it? Yeah, you're going to pay it. So there is that consumer push rather than before it was sort of trying to get access to it. We're seeing, other things from a valuation side. Everyone's terrified of valuations. Nasdaq said about 23 times. .com it was 80 times. So it's different. People talk about concentration. I like to point them to home. So in the UK, HSBC is more concentrated in the FTSE than Nvidia is in the S&P 500. So I'm not saying concentration is good, but I am saying it's there are global elements where actually other nations, other geographical regions are worse. For us, we're seeing the data come through that productivity is really driving. We're seeing the productivity gains. This morning we're in investment committee and we're seeing a logistics company that moves shipping containers, and its share price is going parabolic, and it's going parabolic because they did a lot of agentic AI about 6 months ago, and they're starting to see, and you just see a share price jump, and it's their earnings call. What's a problem for us is as it moves from the largest Mag 7, the largest companies of the world, into the real world, I don't know, it could be a Walmart, it could be a Tesco, as they start putting it through their systems, as investors, us trying to spot which companies are doing it, because it can be now from a handful to the masses, it actually becomes, I think, more difficult to actually stock pick what specific companies are doing it. But I see it here for the long term.
Yeah.
We're super positive.
Perfect, thank you. And Rebecca, Rathbones have been quite tactically defensive in their positioning, rightly or wrongly, in terms of, for the last couple of years. Can you talk us through kind of what your house view is when it comes to the tech stuff and why you've kind of positioned yourself in that way?
Yeah.
And then also the other areas of the market that you've been focused on. I know we've spoken a lot about defence and that side, and where you're seeing investment from that angle.
Yeah, so I think on AI, we've been kind of neutral to slightly underweight for a long time. And that's not to say that we don't agree with your kind of house view of where it's all going. It was more just about the entry points, because some of the figures and some of the earnings multiples were quite staggering. And we were sort of wanting to see a bit more proof in the pudding before we felt like dipping a bit of a toe in. So I know that we spoke about, Alphabet last year, which we went and bought during the volatility in April, and that was one of our best performing holdings of 2025. But we're trying to be quite selective in what we own. I think we probably feel a lot more comfortable with it now because, Nvidia's on 21 times, Microsoft's on 23 times next year's earnings. They're not these staggering multiples of 80 and above that we were seeing not so long ago. I think some of this talk of a bubble that's really gathered pace is almost helping us get more comfortable, because that means that if people are being valuation conscious, then by the very nature of it, that implies that we don't have a bubble. I think where we are seeing a bit of a bubble is perhaps more on the private company side. Nvidia is spending $1 trillion on its AI build out, and it has no, not Nvidia, sorry, OpenAI, and it has no profits.
Yeah.
Stuff like that, when that's being financed through debt, which I think you were sort of alluding to, the parallels to the .com boom bust, that's what we're watching quite carefully. But at the moment, we're kind of neutrally positioned within equities. Defence is something we have been quite positive on. I think at this point it's potentially a bit of a well-trodden path, given that what we've seen in the first kind of 3 weeks of the year. The defence sector's already up 14%. We all know the reasons why that is. It's what we're seeing in Venezuela, it's what we're seeing in Iran, and more latterly in Denmark. I don't think that theme, if the first 3 weeks of the year is anything to go by, is going to go away anytime soon. But I think you might, get a better entry point if you're looking for one.
Perfect, thank you. So Claire, obviously we were speaking a minute ago about this growth that we've seen in prices, and I think for lots of people, if you haven't been in the gold boom, if you like, then you're kind of looking now and thinking, how do I get into this market? Because is it really going to just keep going up and up and up? So how sustainable do you think it is, and where do you think the price is going this year?
Definitely. So look, when I started in this role, it was April 2020 and the gold price was around $14-15. I step into around like that's a price. And now you think where we've come in 5 years, my view on this is there's no reason why that could happen, again. I know it sounds insane, but we're almost, we're at the tipping edge of $4,750 today. So again, 2026 has started like 2025. And the the way that I'm positioning it to investors is you should put the price to one side and look at what the case is. What's the bull case for gold and the bear case going forward? What's your time horizon, like we always say to investors? And if I start with the bear case, there's less of a bear case. You know, I always carry a card reminding myself of things, but a couple of things that could go against gold could be rates go up. But we've been in a period where rates didn't respond to gold, so I'm not really that concerned about that. If Donald Trump achieves what he wants to achieve holistically, minus all the other stuff he's wanting to do, which is increase growth and bring down inflation, that could cause a challenge for gold to a degree. If central banks stop buying, or one signals that now they're selling, that could cause a bit of a wobble. But again, as I was saying to Ed, the last 18 months, 2 years, anytime the gold price has consolidated, the dips have been bought pretty fast because you've got a lot of people in the waiting room who have said, when it comes down below 4,000, I'll get in or I'll top up. So then you flip to the other side and then you think, you know, we are in now a rate decreasing environment. That's traditionally good for gold. We're in a weaker dollar environment, also good. We're in a period of instability, geopolitical risk. And geopolitical risk, I just want to highlight, that is never a reason to just buy gold, just because there is an additional conflict, unless you're a trader and you're wanting to, you know, buy today, sell tomorrow. It's a reason why you should have gold in your portfolio anyway, because it will respond when we see outbreaks take place. Then you've got the role of things like fixed income. Whilst we remain in a positively correlated world where equities and bonds are doing the same, fixed income's role as a diversifier is going to be diminished. So again, it's looking beyond just relying on bonds. And we're certainly seeing that shift from some institutional investors that are saying we just need to reduce the amount of dollar-based assets that we've got, or we need to reduce the amount of fixed income we've got, and we might supplement that with 5% of gold. And then you've got the rise of alternative assets, and that could be infrastructure, that could be property. Gold is still an alternative asset at the end of the day, you know, it's a commodity. And then you've got momentum. So if I just highlight, when we think about ETFs, last year, just under $89 billion of assets went into ETFs. You know, that is significant. And after the US, China was in second place. And then we had the likes of India, even beating, you know, the UK with the amount of flows that go in. So don't underestimate new markets opening up. So Indian investors are now becoming investors in portfolios, which they weren't. And traditionally, they've been big buyers of gold through jewelry, but they are now buying gold as ETFs. And then you've got the likes of China, where the deregulation that's taken place last year in the insurance industry means that now Chinese insurance companies can buy gold, which they weren't allowed to do. So we're always looking for where will net new demand come from, rather than just saying, you know, do I own it in my ISA? Does my default pension have it? I think there's still a long way that this can go.
Yeah.
And my personal expectation is that it will be at $5,000. I said before the end of Q1, and now I'm slightly bringing that forward because the momentum is still really strong. And I think I like the bubble concept, but my view is for a lot of people that talk about bubbles because you don't have a position.
Interesting.
You know, so you're trying to make yourself feel better and be like, it will pop, and then I will then be like, ha, I didn't have it. So again, like think about what a bubble means if you're in or not in a certain asset.
Yeah. Perfect, thank you. Ed, when we were prepping for this, you spoke a lot about the biggest risk you see in the market being inflation. Can you tell us a little bit about your kind of outlook on inflation and how you're positioning to protect portfolios against this?
Yeah, I think for me, inflation is one of the biggest risks out there. I'm actually becoming more, and I'm not super worried about inflation. As in we have, again, everything's context, right? You've got the 1980s, you have hyperinflation 2021, 22. So I'm not saying that. But I think for you know, multi-asset diversified portfolios, inflation is actually going to be more of a concern than your 2008 style recession. You know, I didn't predict markets, but when I come into this morning in Bloomberg, I turn it on. Natural gas prices in America today, they're up 24% today.
Wow.
On it being cold. You know, these are massive moves, and structural commodities are rallying, so that pushes inflation up.
Yep.
Growth in GDP is really high in the world, so we're running GDP. So normal GDP might be like 2.5 is okay. We're running GDP at like 4. We have all central banks across the world, apart from a few, effectively decreasing interest rates, which is great. Everyone here might have a mortgage, interest rates go down, we have more money in our back pocket, maybe we buy a bit of gold, maybe we buy a bit of pizza, but all prices go up, right? Fiscally, governments just want to spend money. America runs, we all are entrepreneurs in the room. I've never been an entrepreneur. I'm sort of a money manager. I do no real actual added value to the economy, as my father likes to say. But you all are entrepreneurs and do stuff. But I've lost my train of thought. I'm sorry. What was I thinking about? I've lost my train of thought. Don't worry about that.
Okay.
And we were on inflation. So, but on the inflationary side, yeah, that's super. I think it's really going to be driven very high. So
Yeah.
on the portfolio side, how are we mitigating against it? So, a couple of things. Fixed income, so bonds, lending money to save people, maybe the US government, maybe not, lending money to save companies, etc. That's like oil of water with interest rates. They don't like it, and they don't like it with inflation. So if I think inflation is high, and I think bonds won't like that, we're lowering our allocation to bonds. And you can do it structurally, or you can just lend money to people for not as long. So we're doing that. We have inflation hedges in the portfolio, so areas like commodities, areas like gold, albeit it hasn't been tracking like an inflation hedge per se in the last couple of years, but certainly areas that we're putting into the portfolio to try and diversify that inflation hedge.
Perfect, thank you. I'm going to go slightly off piece with this question because it's just in my mind and I want to, I'm sure you guys might be interested as well. But Rebecca, when in Trump's first term in office, a lot of market sentiment was driven by the constant kind of tweeting at the time, or Truth Social, whatever it is now, and the swings of kind of his mood and everything were really impacting markets in that first 4 years. Have you seen, obviously we're seeing more and more coming out and his views on various things. How are we starting to see markets responding to that? Are we starting to see it being priced through the noise, or is it still swinging?
Yeah, no, I think it's definitely the former to an extent. So I mean, markets are still surprised, right? I think everyone was surprised, but when they woke up in the morning and saw the headlines about Venezuela, I don't think anyone had that in their model. Correct me if I'm wrong, but we weren't expecting that. But markets aren't shocked. So, the markets generally kind of took that in their stride, and they adjusted for it pretty quickly. Around April of last year, when we saw the trades, I don't know whether you came across this acronym that got coined by Robert Armstrong, the FT, called TACO, which stands for Trump Always Chickens Out. And I think that's exactly what we're seeing now. So in all of this back and forth around Greenland, and he's saying that he's going to whack tariffs on these 8 European countries that were doing pre-planned exercises, almost to appease him, ironically, in Greenland anyway. And then the EU are saying that, okay, well, we've got this bazooka of a very long list of tariffs that we were going to impose on you back in April. And it's just this, it's a war of attrition. It's this, and he will come out with probably some kind of increased military presence in Greenland that he can take back to the US and sort of imply that that's a big win. And both sides can kind of have their cake and eat it, if you like. Yeah.
Perfect. And a follow-on question, not about the US, but obviously in the UK, there's, post-budget, there's a lot of kind of down, and the energy's not great. People are starting to feel the pinch of higher taxation and the impact that that's having, both from the budget previously and now this one. What's your overall outlook on the UK as an investment space?
I think it's fair to say not great. Definitely moving in the right direction though. So again, everyone in this room will have paid probably quite close attention to what was going on around the budget. I mean, you couldn't move for negative headlines about the future of the UK. It was awful, and we saw that in the figures as well. Like business sentiment, consumer sentiment figures, they were all extremely downtrodden. There are some kind of green shoots at the moment. So we've had some fairly promising data about the housing market coming out. Things like wage growth today, not as bad as feared. So it may be that further rate cuts can come through. So I think, there are some early signs of a recovery, which is looking pretty promising. But I think we are pretty path dependent on what happens to inflation, to come back to what we were talking about a moment ago, and then therefore the ability of the Bank of England to cut interest rates.
Perfect. And Ed, do you have anything else to add? Like, how are you positioned in your portfolios from a UK perspective?
UK, yeah, I mean, so we've been a global house for a number of years. So we've been pretty, but that, so underweight UK. I mean, the UK is 3% of global equities, so it's a really small allocation structurally for a global house. Yeah, for me, it comes down to return on equity. You just chart the return on equity of American companies, and you chart the return on equity of UK companies. And yes, the valuation is a lot higher, but you're just getting so much more rapid growth in pretty much everywhere but UK.
Yeah, perfect. Thank you. Claire, can you explain for those who maybe haven't got gold, a little bit about the different types of gold that you can hold, and how you can get into that market?
Absolutely. So there's a bit of gold for everybody, and it's a little bit like choosing from a menu. So if you're thinking about wanting to buy some physical gold, a couple of things to bear in mind. If you buy gold sovereign coins, they're great because they're capital gains exempt. So some people like to have, the physical asset at home. You can buy it from places like Sharps Pixley, the Royal Mint. That's a good option. If you're managing your own ISA, LISA, SIP, then you can buy something called an exchange traded commodity, otherwise known as an ETF in the US. In the UK, there are multiple ones. The two leaders are from iShares, BlackRock, or from Invesco. And if you just put into your AJ Bell or Hargreaves Lansdown, ETC Gold iShares, you'll find it. It's 12 basis points, 0.12%. It's in line pricing wise with other assets. If you want to buy, maybe you're an ultra high net worth and you work with a private bank, you want to buy, large bars. I mean, they're quite expensive now because the price has gone up. You could buy it in a multi-asset fund. You could buy a commodities fund, a precious metal fund. So there are lots of different ways to buy it. And again, how much should you have? All of the analysis that we do as an organisation kind of suggests between 5 to 10% of your overall portfolio. So this shouldn't be a big decision because it's a relatively small amount, but you've got to have enough for it to do its job. So if you're only going to allocate maybe 1% of your portfolio, it might not do what you're expecting because it needs to have kind of enough in there. And for us, that kind of entry point as a minimum is probably 3%. But if you're doing it through a SIP or you've got a financial advisor, again, these are things you should just be asking them and thinking about its liquidity. It's really liquid, so you can buy and sell gold like you would an equity on an exchange. The liquidity is actually on a daily basis more than UK government bonds. So this is also an area of gold that is underestimated. I think where the knowledge levels for people is they just envisage these kind of big bars of gold sitting in a corner and think it can't be liquid. But think of it like a currency in that it trades, in the last year, it's been above $300 billion a day on an average day, on a volume basis. So it's really, really liquid. And it's also something that you can sell if you need to. That whole classic, I need to sell, I don't want to. Gold often in a crisis will sell off first because of its liquidity profile. So if you go back to March 2020, it came down before it started its ascent. And that's because investors went, crikey, I need some cash. Right, let's flog that and we'll buy it back in a week, but I need the cash in my account by tomorrow. So it's not an illiquid asset. That's kind of the main thing to focus on. And of course, you can buy jewellery. Who doesn't love jewellery? Buy it for yourself or ask somebody to buy it for you, and then you've got some gold.
Amazing, thank you. And Ed, when we were talking before this, you also spoke about how much you are watching and getting involved in Japan as a investment space. Can you tell us why you like Japan as a holding?
Yeah,
Or sector?
We're trying to work out where in the world isn't doom and gloom or isn't a bubble. And Europe's a great place. Emerging markets is a great place. I'm pretty positive on Japan. So you've got a couple of different things. It fundamentally starts with corporate reform. So Japan has historically been quite sleepy. Companies don't do a lot. They sit on a lot of cash. They use the argument of it's a rainy day fund. Why wouldn't I want to have that? And we're starting to see some evolution there. We're seeing them become much more accurate with how they deploy their corporate balance sheet, i.e. they're either giving dividends back to investors, they're buying back shares, they're selling off non-core assets. We've got a new Prime Minister in, Takeshita. She's really driving and continuing the corporate reform, and so you're starting to see wage growth. Who doesn't like wage growth if you're employed? And entrepreneurs don't like wage growth, but I quite like wage growth. But that's also good because it's driving consumption in Japan. You had lost decade of very little inflation, very low interest rates, very low demand. And now with these things like wage growth and actual, you're starting to see consumer-driven inflation coming forward, and that's actually allowing companies to increase prices. So you have companies like, very large companies like Toshiba, and they're actually able to put in price margin increases and price moves, where in England, in Europe, in America, that's just the norm. I hit April and Vodafone tells me my mobile phone bill's going up by RPI plus whatever number they pick. That's like completely alien in Japan. It's like we're allowed to put up our prices. It's like, yes, well, you can if you wish, and your margins will increase at time. That twinned with an incredibly cheap yen. So we try and trade the asset, but we like trading the currency as well. So today, on the back of Greenland, we're having a sell all of America day. So bonds are selling off, equities selling off, dollars selling off. And if I sit there and I say, okay, well, if I need these safe haven assets, gold's one, but I need to hedge it back into sterling, or I need to hedge it back into euro. You've got Swissy. You don't have many other places, and yen is at the moment continuing that safe haven asset class, which is useful in a high valuation world.
Frank, can I just add, actually, Japan for us is a huge market, and it's underrepresented when it comes to gold products. And again, you've got households sitting, money sitting under mattresses in deposit accounts. They haven't been in an inflation environment for 30 years. So there's a whole shift coming down there that we're anticipating and trying to get people thinking about and buying gold who have never bought it before, or maybe their grandparents did, but they haven't needed it thus far. So I really do echo what you've said about Japan. I think there's a lot of interesting things going on there.
Perfect, thank you. Rebecca, when I was look back to conversations I was having with clients in say 2019, 2020, sustainability was on the tip of everybody's tongue in terms of how they're wanting to invest their money, have an impact and so forth. I'm not going to touch on this too much because what we saw since then is actually sustainable portfolios have really struggled in these more volatile markets, particularly since Ukraine-Russia situation. What's your view, or how many clients do you have that are still wanting to invest in this way, particularly when you've got someone like Donald Trump in the White House with his views on sustainable investing?
Yeah, still quite a lot. I think it's really interesting because, I've got clients who work in kind of UK and US, large listed companies. And a lot of them are saying that a lot of these sustainability initiatives are still going on. They're just not shouting about it for the time being because they don't want to draw the ire of a certain somebody. And I think we are seeing clients being incredibly interested in that side of things, particularly now that things are a lot cheaper. If you look at some of the renewable energy sector, if people are actually ESG investors, then there's definitely a better entry point into some of those names at the moment. I think what's really interesting is what has happened to defence, because previously that was kind of untouchable from an ESG perspective. And actually what Trump has done is kind of attracted this renewed interest from those people who previously had restrictions on the sector, because actually they now see defence as a way of kind of preserving global security. So actually some of my investors who previously had a restriction on it have said, actually, I want to see some of those names now included in my portfolio. So yeah, there has been a couple of shifts, I think.
Perfect, thank you. And Claire, from a sustainable perspective on the gold side, how do you kind of, obviously there's more and more people now wanting access to gold. How do we try to balance the impact that that's going to have on from an environmental perspective?
Yeah, it's a really good question, and a couple of things that I'd start with. So when you talk about mining supply, it's broken down into newly mined gold, so production and recycling. So recycling makes up about 30 to 40% of total supply. So that's an individual taking a necklace to a jeweller's and it being repurposed, recast, a bar being melted down. So it's not just gold that's coming freshly out of the ground. There's about 215,000 tonnes of gold that's already above ground. When you focus on the stuff that comes out of the ground each year, it's about 3,500 tonnes. So it's really small. So the impact is, I think, less than a lot of people think. But what the gold miners are doing and have been doing for many years, and just to come back to a point around our organisations. So we're a membership organisation, and it was actually gold mining companies that founded us 40 years ago. So on our board, we have more than 30 of the world's largest listed gold miners. So that's the Barricks of the world, Newmont, anybody that is kind of large scale mining is who we effectively report into. We also have a membership, compulsory membership requirement, which is called the Responsible Gold Mining Principles, which they have to adhere to and then go and get third party assurance on. So that is environment, that is the use of, how they use domestic labour. What's their plan once all the gold that they found they're taking out, so almost like the rehabilitation plan for the site. So there's a lot that they're doing, and they are much more in practice of being questioned by shareholders on that. So it is taken seriously. At the end of the day, gold is taken out of the ground. It's an extractive industry, but you can also look at things like what is gold's carbon footprint. But to be honest, what I found really interesting in just the shift of views, probably in that time post 2022, is the amount of questions that I'm getting on that now have almost disappeared. Whereas in my first 2 years, it was almost in every meeting, an investment committee meeting, because trying to get the buy-in from a committee which would say, how does this look through an ESG lens? But I honestly can't remember the last time I was asked that by a big investor. And I think sometimes narratives, they will move up and down in their priority. But there's a lot more, I think, that they're doing now than they were doing in the past, because they do have that responsibility to report to shareholders and be able to speak about that. So it can still be a barrier to entry for some investors, but I think there's a lot that the industry can say and speak about and point to examples of what they're doing.
Perfect. And just to follow on, it's not just gold that we've seen the increase, precious metals, and start with you, Claire, but a question for everybody. We've seen precious metals increasing, albeit particularly volatilely, with silver prices, copper. What's your view on other things? Are we going to see similar response to what we've seen in gold in those markets? Is that something that you're looking for in your portfolio?
I mean, I was even reading last week about now people are interested in tin, and I was thinking, God, where is this going? Should I now have is there even a tin ETF? I need to look that up. But I think there is now an opportunity for precious metals that maybe wasn't an opportunity before. Silver and gold are really different. They're almost a bit like cousins, and sometimes they get on and sometimes they don't. Silver is more volatile anyway. It's more used for industrial usages. It's not used as a reserve asset in central banks, and I think that's a key differentiator. So I wouldn't say it's do I buy one or the other, but you're going to be buying them for different reasons. I think silver is, it has just gone on a complete tear, and I think there is a lot of momentum driven people jumping on, and I think maybe some investors that didn't buy gold have gone to silver, and then that's kind of propelled the momentum. So I think there's a case for precious metals in portfolios, but I still think, and we still think, that gold has a strategic role in the portfolio, and silver, I think you've got to treat a bit more tactically, and you've got to be able to view, follow something. Like I'm equally looking at copper. I've had that in my portfolio for about a year, and it's done really well. But I'm keeping an eye on it, and I'm thinking, at what point does it reach a point that I think that that's enough for now? I'm happy to have been a participant, but it's probably not going to stay in my portfolio until I reach retirement. So they are a community of metals, but they do behave differently, and I think that's where your starting point should be. But if you don't have any precious metals right now, I think it's something you should do a little bit of research on and just get comfortable with, an amount. Either spread all your risk or start with one and then build. Like you always say, start with your foundations, have your cores, and then your satellite positions. I would probably think of it like that.
Perfect, thank you. Are both of you holding beyond gold in your portfolios? Maybe you, Ed?
So right now, no.
Okay.
We've traded copper in the past, long commodities. We have gold right now, but coming in late 25 into 26, cyclicality is definitely the story that's driving. What I mean by that, so 2025 was all about AI. That was then you had defense in there. You had a few other things. You had liberation/liquidation day and Mr. Trump. But fundamentally, AI was probably the biggest theme, apart from gold.
Yeah.
This year, it's actually most other companies, excluding the Mag 7, the biggest companies, that's driving the market. And if that's the real economy rather than sort of the cloud economy, they need physical, goods to actually create it. Industrial production is up at the moment manufacturing PMIs are up at the moment, and that'll lead into it. I think through the cyclical industrial metals lens.
Yeah.
So that would be your tins, your irons, your coppers, etc.
Yeah.
So not at the moment, but it wouldn't surprise me. We've on the investment committee. There's 4 of us. One of us is a South African. So we're always banging the drum that one, he's always sad when he comes back to the emerging market, i.e. UK. 2, we should have much more commodities into our portfolio. So they could go there.
Amazing, thank you. I'm going to think it's going to be final question from me. So I'll go down the line, maybe to do Rebecca to start. But if there was one piece of advice that you could give to those who are looking to invest this year, what would it be?
For me, probably a really boring one, but just make sure you're diversified. And I don't just mean by asset class, look at commodities, look at equities, look at your bond exposure, but geographically and also sectorally, as you've just touched upon, there is this kind of theme that the baton has been passed away from the technology companies to an extent, and that we are going to see this broadening out of market performance. I think there's lots of scope as we do see further interest rate cuts come through for some pretty unloved sectors to start rallying there. So things, income generating sectors. So real estate's been pretty unloved for a while. Typically, you should see that start to performance rates start to come through as well. So don't put all your eggs in one basket.
Perfect, thank you. Claire?
So I would say, and I'm going to give a bit of a personal touch to this as well, it's all well and good being smart and thinking about saving and retirement, but we should also think about spending money and just living. I think there's all this pressure on us, put money in your SIP, do your corporate pension plan, try and reduce your inheritance tax, all this type of stuff. And it just distracts from enjoying going out with your friends, going on a nice holiday. And I think a big view that I've shifted recently is I don't have any kids. I'm not going to have any kids. So I'm working really hard. I'm accruing assets and I'm going to leave them to nobody. So I'm just going to spend as much as I can with having a will in place. And, if some of my friends survive me, they'll get a lovely little check. But I want almost that last check to bounce. So life is for living. Be smart and save. Be sensible, but just enjoy. Don't worry about what's going on a like minor basis. If someone invites you on a holiday, just go, what's the worst that can happen?
Yeah.
Just don't put $2,000 in your ISA and just go and have a nice day.
It's so funny, and I'm going to come to you, Ed, but I'm seeing a lot at the moment where clients are at the other end of their journey, and they're realizing they've saved so much, and it's really hard to get yourself into a spending mentality when you've spent your whole life saving and doing all the things that you should. But actually you've almost got another child in HMRC coming with the inheritance tax. And so this spending mindset, obviously, we need to make sure our basic needs are met. But I think it's about having balance, particularly when we're in this taxation environment that we're in.
It's so true. I almost want to make a call out to all those individuals and say, go out for lunch with me and I will give you so many ways in which you can spend money. So I think I've got an opportunity here. It's like, just let me give you some ideas, just get out there, do what I've done for the last few years and just enjoy yourself.
So I think that spending mentality is important. Ed?
No.
Something more sensible.
No, I mean, there's have good financial advice. The anecdote I like, it's true. So there's Hargreaves Lansdown and AJ Bell in the UK. Fidelity is one of the big trading platforms in America. So they have all your data. They can see everything. They're like Big Brother. And they did a study on their best performing portfolios. I didn't commission it, so I can cheat on them, but I would like to. And it's a true story. You can look it up on Google. The best performing portfolios in Fidelity in America are those who are deceased and those who have forgotten and logged out of their passwords. So the advice is, number one, great foundations, great financial advice. Number two, leave it the hell alone. You'll probably be okay.
Perfect. Thank you so much. I'm going to open to the floor to questions. Before I do, though, these cards seem like a really cute idea, the start of our new thing. So apologies, there are lots of questions missing because I went from question 6 to question 14, which is why there were so many
notice.
things that were not are not prepped for. So well done, guys, because that was a bit of improvisation on the spot. I was like, the maths doesn't add up here. Where's my card? So I'm sure there are things which I now know I've missed, but I'm going to open to all of you and let's see where the conversation goes for the next sort of 10 minutes, if that's okay. So does anybody have any questions that they would like to ask? Laura?
Can I be greedy and ask 2 questions?
Absolutely, fire away.
One's to do with gold and one's to do with Japan, specifically the yen. I'm just wondering, of your recommended 5 to 10% gold allocation, what, if any, of that should be focused on gold mining?
Mhm.
And Ed, for Japan, what's the best way to get into the yen? Is it to just to go into like an emerging markets, Japan-focused ETF, or is it something more specific to get exposure to the yen that you're talking about?
Yeah, really, really good question. And I think the first thing about gold and gold miners is they're different investments. You know, gold bullion is going to perform the way it has. Gold equities are equities, so you're going to have credit risk, operational risk. You can't think of them as the same. But again, I hold both because I want to be experiencing, I guess, the journey of gold in both ways. So you have to think about what are you after. Again, there are gold mining ETFs. I would treat them again slightly differently to how I treat. I'm always going to want to have a proportion of my assets in physical gold, and I'm keeping an eye on the miners. I mean, I bought the miners when I joined, and I spent a lot of that time in the red. And, you know, it's like, but I'm rallying around the members and I'm sure all will come well. But again, if you think about the way in which gold has responded, it's only really been the last year, maybe 18 months out that the miners have responded. Because just because the gold price goes up, you know, gold production isn't like a factory. You can't just turn on another machine. Getting gold out the ground is a long process. It requires licenses. There are lots of permits that are needed. So it's not a like for like. Just because gold goes up doesn't mean the mine's going to go up in tangent. But I think there is an opportunity to even diversify within your gold holdings. So I would maybe start with physical gold, and if you're looking to make some changes to your equity portfolio, that could be a time to introduce even like copper miners, you know, rather than, so maybe thinking about your basket of precious metals from a mining perspective could be the way to do it.
Yeah, thank you.
Yeah. I think it depends what you're trying to get access to. Are you trying to get access to the actual yen, or are you trying to get access to the yen via another asset class? And I'll answer it in a wider point. So you can get access to the yen via equities, but then you have a long, you know, you have a high volatile asset as in equities. And if you're trying to buy yen for defensive asset classes, the equities will swamp the defensive qualities of the yen. You can do it via the bond market, so what's called JGBs, which is Japanese bonds. Problem is, with inflation, you know, increasing, and Japan's probably much one of the only central banks in the world to increase interest rates, Japanese bonds are losing value. So you don't, and they have very long terms, so you lose even more money, and so you don't really want to do it through avoiding JGBs. You could do pure cash, so you could literally swap sterling into yen. The problem you've got, so in answer, there's not going to be a simple way. The problem is called negative carry. What is that? It's like me carrying a bag. You know, what's that? But it's actually, you know, in Japan you're getting about 1.5% interest rate. Here in the UK, I'm getting 3.75. So the yen has to appreciate by over 2% standing start, not including fees, just for it to work. One of the ways we thought about doing it, and again, I don't think it's particularly exotic, but it's a bit funky. If you're likely to have, let's say, the S&P 500 in your portfolio, which is pretty, you know, stalwart, you know, you can have lots of it. If you don't like tech, you can have not very much of it, but you're probably going to have it in there. Yeah, there is a Japanese listed S&P 500 hedged to yen. So if you're going to have S&P anyway, you know, you can buy it and then hedge it to the yen, then you get your yen exposure. Your performance contribution will be a bit of a mess, as in like you'll get yen contribution and equity contribution, but it's a way of accessing it. So I think it depends. Are you speculative and you just go long Japanese equity, or are you trying to actually access the yen, not through derivatives? That's the cleanest, but when you get into the retail world, the actual derivatives is quite hard to access. Sorry if that's long-winded.
Yeah.
I love the buzz you check before you die, by the way. I'm going to take that home for me. I think that's great. I just wanted to ask, what about Bitcoin? None of them talked about Bitcoin as a hedge, and I'm particularly kind of interest in that area.
Yeah.
And we think about gold, you think about Bitcoin prices and how that works on supply and demand.
Yes.
Why are you guys not talking about that in crypto?
Yeah, I mean, it's
So
a great
I'd
question.
love to know
And
your
again, I think
opinions on that.
the questions have just died down. I mean, I was in the foray of it, when the first Bitcoin rally took place. That's all the questions we were getting. I think first and foremost, they are complementary, not competing assets. So you have one, you should probably have the other. Again, Bitcoin
So how
is
would you
still.
position that versus gold, for example? We're
Yeah,
talking
no,
about
that's
10%. Oh,
exactly
right, okay.
exactly that. So
Yeah.
it's not Sophie's choice. Should I just have one?
Yeah.
It's a case of, if I've got Bitcoin, my volatility in my portfolio is going to go up. So I should still be thinking about a diversifier.
Mm.
And when it comes back to use cases, you've got Bitcoin, I want to buy, you sell to me, I buy. When we look at gold, you've got fabricators, you've got central banks, you've got investors, you've got more of a supply and demand setup. It's not one-to-one, investor to investor. There are the consumers and then there are the investors. So I think that user case is really different. Yes, they're both being mined. I think there's room for both of them. I think.
And central bank, right? Bitcoin will be central bank in the US soon, right? I believe.
I mean, then you're talking about. I mean, it's whether they do this Bitcoin reserve, but again, it's another narrative that's sent up with a pigeon. Yes, I'm sure central banks at some point will start buying Bitcoin, but I'm not sure they're going to sell their gold to purchase it. They may end up reducing treasuries. It's one of those. Whatever happens, if I'm an investor in gold, that I don't think that's going to be the only catalyst or thing that will change the thought process of owning gold. I think Bitcoin has just been on so many. I mean, I actually bought £100 on Revolut, I think last December, just for the funds of it. Just to be like, I am a participant in something else. But it's not. They're not the same thing, and I think that's often the error that people make, that they do behave the same and they don't. So by all means buy one, but if you get on a plane, ask for a life jacket. So it's the same thing. If you're buying a cryptocurrency, it's going to increase the volatility and you're looking to smooth that out with something like a diversifier like gold. So I think there's a use case, but treat them and do your research.
And I think we've spoken about it before, haven't we, Rebecca? And obviously it's still Wild West in many ways. I think that from my perspective, clients are having those conversations a lot. And my advice really is that we don't advise on it, but it's a satellite play that could be in your wider strategy. I think the most interesting part of the market personally is stable coins and things that can be pegged to currency. But again, what's going to be the winner in that space? It's just, I don't think any of us can really say at this point. And I think that's where, when it becomes so mainstream and spoken about as it is, and you always hear normally about the gains that people have got rather than the losses, I think that it's a very kind of difficult market
I think
to
since we
navigate.
were last speaking about stable coins, one of the major stable coins have lost its peg, didn't it? So
Yeah,
I think it just, I
Not so
mean,
stable.
yeah. I mean, when I first started doing this 10 years ago, people were saying, oh, it's an overnight thing, it's going to disappear. That's clearly not the case, right?
Mm.
It's becoming more mainstream, and I think it will become more interesting. But for what I'm doing, I find it really hard to fit it in my risk frameworks. It doesn't perform necessarily like a diversifier, as you've just kind of alluded to. And it doesn't, the driving forces behind it are not the same as any other asset class. It just seems to be kind of simple supply and demand at times, and then at other times you get these greater forces coming in. So it's very hard to pin down. So what I do say to clients is, like, for the time being, I'm not going to own it in portfolios. But depending on your risk appetite, if you want to go and have, a separate fund where you do that kind of thing, let's see what happens.
Yeah. I love the conversation where someone will say, well, I've got Bitcoin and I just went and bought a coffee with it. I said, yeah, I do that with my debit card every day. It's called cash. So it comes back to, what is the use case for it? You're swapping something to buy something you could buy anyway.
Yeah.
Like that's not exciting for me. But having it as having it as an alternative something, fair enough. But let's not convince ourselves that it's doing a job in society that something else doesn't already do.
Yeah. Perfect. I think we've got time for a couple more questions. Does anyone? Yeah, lady here. Yeah.
So I think you didn't mention about the private credit market. Do you have any exposure to the market? And then what's your view on the market? for 2026?
Yeah, Ed, do you want to take that?
We've got no privates, but that's more of a function of how I run portfolios. So my view is liquidity is the oxygen of markets. So, we could do privates. I could show you the screen and the valuation. I could say, look how much money you've got. Aren't I very clever? You then ask for a cup of coffee. Can you take that money back and spend it? And I say, no. And it doesn't really work in the sort of the private bank situation when we're trying to look after family wealth. So we don't have any directs. How do I think about private credit? Well, okay, let's take a step back for the room. What is private credit? Private credit is a loan that's made by a non-bank lending entity. So that can be an investment company, it can be a hedge fund, it can be some private individual. So that's what private credit is. Typically, non-bank lending credit versus bank lending credit is underwritten with lower quality standards. Not always, but it can be, i.e., they're lending to investors who either can't get it via the traditional banking route, as in the bank said no, so you have to pay a higher income from another company, or it's pretty niche stuff and again, a bank doesn't want to touch it. The problem for me where I sit is I don't have good data. As in the gold market, I fire up Bloomberg, I type in a few things, and I get a lot of data. Whether it's accurate or not, you're ex-Bloomberg, you need to tell me that it's accurate. Accurate, perfect, tick. In the private credit side, it's literally person-to-person, company-to-company transactions. So understanding how big the market is, understanding the lending quality, the terms, how it's structured, it's all estimates. What we do know in our world is it's getting bigger because a lot of the data centers, a lot of the AI capex has so far been met via organic earnings growth. It's starting to move into the debt market, listed and non-listed. So again, the listed stuff I see, but it's you're getting a structure of SVB set up, SVP, so special purpose vehicle set up, cash injected in, SVB lends out to data center buys it, asset of the SVB is the data center, and then there's a contract with Meta for like 30 years. So Meta's at arm's length that, okay, they're on the hook for paying the money, the rent, but if it all goes wrong, it's an SVB. And so we saw it with things like, it's a subtle side thing, more sort of more interesting a couple of years ago, but like WeWork. So like we would pitch WeWork, and like, great, multi-billion pound. Oh no, it's not. It's a one special purpose vehicle, one site, one building thing. When this goes wrong, no, it just falls away. So it is a concern. It's difficult to measure, but yeah.
Perfect. One more question. No.
I've got one
Oh.
for you.
Oh God! Panelists.
We have spoken quite a lot in the past about recycling of gold and how we haven't really seen that cycle. What's happened since we last spoke about it?
Yeah, we haven't.
Are we saying that?
Very good question. That's almost like one of our wild cards as to what's gone on this year. And I think fundamentally it's because economic conditions aren't that bad. If you go back to the GFC, so the global financial crisis, wasn't that long ago, and you saw a lot of recycling then because people were losing their jobs. They were struggling. We haven't seen that amount of economic distress, nor I think that another thing is that the stock hasn't rebuilt. But something that happens a lot in India is that people will lend their gold or they will recycle it. But in places like that, we're just not seeing it at the levels because I just don't think people either want to, because they want to hold on to it because they think it could go higher, or they just don't need it for the funds. But it's a really, really good point. And so we bring out a quarterly report, and our Q4 and full year report is coming out at the end of the month. So I think that's a big area of interest for us, because that's almost been, it's weird that it's not happening
At these levels.
But either people are holding on to it or they just don't need it.
Perfect. Thank you so much, and thank you to the three of you. That's been a brilliant discussion. Thank you.
Thanks for joining us.